Building a fortune that lasts through generations isn't about gambling on the latest market trends. It's about choosing investments that steadily compound your wealth while you sleep. In a world where markets swing wildly and economic uncertainty looms, one strategy has proven itself time and again: dividend investing. And as we move deeper into 2026, certain dividend stocks stand out as exceptional vehicles for long-term wealth creation. These aren't just companies that pay dividends. They're financial fortresses that have weathered decades of economic storms and emerged stronger each time. Understanding the power of dividend aristocrats, the stock market has a special category of companies that have achieved something remarkable. These businesses have increased their dividend payments every single year for at least 25 consecutive years. Known as dividend aristocrats, they represent some of the most financially disciplined and shareholder-friendly companies in existence. Currently, there are 69 stocks that hold this prestigious status in the United States. What makes these companies exceptional isn't just their ability to pay dividends, but their consistent growth through recessions, market crashes, technological disruptions, and global pandemics. When a company raises its dividend for 25 straight years, it's telling investors something powerful about its business model, cash flow generation, and management quality. These aren't speculative bets. They're businesses with proven staying power and competitive advantages that protect them against rivals. Companies like Medtronic, Walmart, and Coca-Cola have built economic moats so wide that competitors struggle to cross them. Their brands, operational scale, and customer loyalty create self-reinforcing advantages that drive profits year after year. Healthcare giants delivering reliable income, the healthcare sector offers some of the most compelling dividend opportunities for long-term investors. At the forefront stands Medtronic, the world's largest standalone medical device maker with a market capitalization of $132 billion. The company invented the battery-operated wearable pacemaker and now produces everything from defibrillators to heart valves to insulin pumps. What sets Medtronic apart is its recent expansion beyond traditional hardware into smart medical devices. Its artificial intelligence-powered system helps doctors detect even the tiniest polyps during colonoscopies, while its camera-in-a-pill technology allows physicians to view inside digestive tracts without invasive procedures. In the second quarter of fiscal 2026, Medtronic reported revenue of $9 billion, representing growth of 6.6% year-over-year. The company currently offers a dividend yield around 2.75% and has raised its dividend for 48 consecutive years. With a sustainable payout ratio and strong free cash flow generation, Medtronic appears positioned to join the elite Dividend Kings Club within just a few years. AbbVie represents another healthcare powerhouse that income investors should watch closely. Already a dividend king with 54 consecutive years of dividend increases, AbbVie yields nearly 3%. The pharmaceutical giant successfully navigated the patent cliff of its blockbuster drug, Humira, by investing heavily in research and development. Today, the company has 90 programs in its pipeline, including 60 mid- or late-stage candidates. In the quarter of 2025, AbbVie reported revenue of $15.8 billion, up 9% year-over-year. The company generated more than $19 billion in cash flow last year, providing ample resources to fund both innovation and shareholder returns. Consumer staples anchoring portfolios. When economic storms arrive, consumers still need to buy everyday essentials. This makes consumer staples companies some of the safest dividend payers in the market. Coca-Cola exemplifies this defensive quality. The beverage giant has increased its dividend for 63 consecutive years, making it one of the most reliable dividend growers in history. Currently yielding 2.6%, Coca-Cola owns 30 brands that each generate more than $1 billion in annual sales. The company has evolved far beyond its namesake soda, expanding into bottled water, fruit juices, teas, sports drinks, energy drinks, and coffee. This diversification helps offset declining soda consumption rates in developed markets. Coca-Cola's capital-light business model gives it exceptional profitability. The company only sells concentrates and syrups, while independent bottling partners manufacture and distribute the finished products. This structure enables Coca-Cola to maintain stable margins and generate substantial cash to fund dividends. Organic revenue rose 5% in 2025, and management expects 4 to 5% growth in 2006. Walmart provides another example of consumer staples strength. The retail giant raised its dividend by 13% in 2025, marking its 52nd consecutive year of dividend increases. While Walmart's yield sits at just 0.72%, the company's consistent double-digit percentage dividend growth means long-term shareholders enjoy expanding income streams. Walmart has successfully competed with Amazon by building sophisticated e-commerce capabilities, while leveraging its vast network of physical stores. The company operates more than 10,500 stores and clubs worldwide, giving it unmatched scale in brick-and-mortar retail. Real estate investment trusts for monthly income. Real estate investment trusts offer unique advantages for dividend investors. By law, these companies must distribute 90% of their taxable income to shareholders, resulting in above-average dividend yields. Realty Income stands out as the premier monthly dividend payer in the REIT sector. The company has increased its dividend for 30 consecutive years and yields approximately 5.5%. More impressively, Realty Income has raised its dividend 133 times since going public in 1994, including 113 consecutive quarters. The REIT owns over 15,000 properties across 9 countries, specializing in long-term net lease agreements with major corporations. Its diversified portfolio includes retail properties, industrial facilities, gaming establishments, and data centers. Top tenants include household names like Dollar General, FedEx, Walmart, and Home Depot. Realty Income maintains a 98.7% occupancy rate, demonstrating the quality of its properties and tenant relationships. The company invested approximately $6 billion into new income-generating properties in 2025, providing fuel for continued dividend growth in 2026 and beyond. Its conservative financial management and diversified investment strategy make it an ideal core holding for income-focused portfolios. The mathematics of dividend investing reveal why these stocks create lasting wealth. When you reinvested dividends to purchase additional shares, those new shares generate their own dividends, creating a compounding effect that accelerates wealth accumulation. A company that grows its dividend by 5% annually, while you reinvest those payments, can produce remarkable long-term returns. Consider an investor who bought Dividend Aristocrat stocks 20 years ago. Not only would they have received 2 decades of rising income, but the share prices would have appreciated significantly as well. The combination of dividend growth and price appreciation has historically outperformed non-dividend paying stocks over long time horizons. The key is patience and consistency. Dividend aristocrats don't promise overnight riches or triple-digit returns in a single year. They offer something more valuable: sustainable income growth that weathers market volatility and economic downturns. When technology stocks crash or speculative investments implode, dividend aristocrats keep paying their shareholders. Their business models depend on selling products and services that people need regardless of economic conditions. As we navigate 2026 and the years ahead, the companies that have demonstrated decades of dividend growth deserve serious consideration in any long-term portfolio. They represent proven winners with the financial strength, competitive advantages, and shareholder-friendly management needed to keep delivering results for years to come.